IRP5, you have IT3R, you have all these weird names and you're just like, what does this mean?
Young, black and beautiful.
Welcome back to Venture Cat. This is Kat and today we're talking about taxes. Income taxes to be specific. This is part 1 of the tax series that I'm going to be having, and in this tax series I have a video about the different forms that you need. You know, you have your IRP5, you have IT3R, you have all these weird names and you're just like, what does this mean? So I'll just go have a video dedicated solely to that. Like, there's this form that you need, what is it, what must be in the form, and there's going to be a video about e-filing, how you can register on the SARS website using e-filing and file your taxes there. And yeah, essentially just stay tuned because it's going to be we're going to try and understand these things. Today we're going to be discussing how to calculate your tax, or essentially how tax is calculated based on your income, based on all of the deductions that you may or may not have, your rebates and things like that. So let's get into it. So first of all, in order to calculate your tax, you need to know what your gross income is. So your gross income is the amount of money that you earn over the tax year period. So for a tax year, it usually starts from the 1st of March, say for example 2019, until the end of February, so the 28th or the 29th of February of the following year. So your gross income is all of the money that you earn within the tax year, and that includes things like the salary from your employer, rental income if you're renting out a place somewhere, money that you get from a trust, like if you're a beneficiary of a trust, and other types of income. Some income is exempt from the tax calculation, and this is called your exempt income, and it means that you won't be charged tax on this income. Your exempt income includes things like agricultural income, your income that you receive from local dividends, your interest income that you receive from local interest bearing assets. So and that is only up to a certain amount. Interest income is exempt for an amount of up to 23,800 if you're under the age of 65. Alright, so you have your gross income and then you have your exempt income, and your gross income minus your exempt income is just equals to your income that we will be looking at. Once you have your income, then you have certain things that can be deducted from that income in order to get your taxable income. Your deductions are essentially something you can look at it like, you know, SARS is like, okay, these are necessities, these are expenses that you have to pay for, and because of that we aren't going to tax you on those particular expenses. Or it can be that it was goodwill and we're not going to tax you on that particular goodwill. So your deductions include your contribution towards your retirement, and that would be your contribution to your retirement annuity, your pension fund, or your provident fund. That is capped at a certain amount, which is 27.5% of your income. And when I refer to income, I mean that gross income minus your exempt income. That is the income that I'm referring to. And then you also get deductions on the amount of money that you've donated to public benefit organizations. So if you've donated to a charity that is registered with the government as a public benefit organization, then you can get deductions on that money that you contributed, as long as it's less than 10% of your income. The next deduction that you have is travel allowance claims. So if you've been doing travel for business purposes over the course of the year, then you can claim that back as a deduction, as well as other costs that you incurred for, you know, purposes of work, and other deductions I will just put on the screen as well. So now you've had your gross income, you subtracted your exempt income, and then now you subtract your deductions, and then this gives you your taxable income. So once you have your taxable income, you use that to calculate what is your tax amount. So in order to find out what your tax amount is, you'd have to use this tax table that's available on the SARS website. I'm just going to put like a screenshot of it over here. And the way that this works is that you get taxed a higher and higher amount or percentage based on the amount of money that you earn. So if you earn more money, you get taxed more money. And yeah, that's just the way that it is, unfortunately. However, the increase in the percentage is on a sliding scale. So it means that for each category of income, you will be taxed a particular amount. For example, this is just an example not based on actual figures. Say you earn 100 Rand a year, and on that 100 Rand, you get taxed an amount of 18%. It means that over that year, you are going to pay 18 Rand in tax, in income tax, right? And then if you have someone else who earns between 100 Rand and 200 Rand, and the tax rate is that for any amount between 100 Rand and 200 Rand, you need to pay 25% tax. So it means that that person who earns, say they earn 200 Rand, it means that they will be paying 18 Rand for the first 100 Rand, and then it means that for the second 100 Rand, they will be paying 25 Rand, which is that 25% in that bracket, right? Which means that in total, for the 200 Rand that they earn, they are paying 18 Rand plus 25 Rand, which is equals to 43 Rand. Meaning that you are not paying 25% on your whole income, you are only paying 25% on that later portion, and you're paying 18% on the portion before. I hope that makes sense. I really hope that it makes sense. But in the table, that's basically how they get those amounts over there. Yeah. So now you've gotten your gross income, you have your exempt income, you've subtracted that, you've subtracted your deductions, and you have your taxable income. Now you've used the tax table to calculate your tax amount, right? Your normal tax amount. So once you have your normal tax amount, you get rebates from SARS. And your rebates is basically just SARS saying that, okay, from that tax amount, we're going to deduct a certain amount of money, and you don't have to pay that tax at all. So if you are below the age of 65, your tax rebate is 14,958, if I'm not mistaken. And essentially how they get to that number is based on the minimum threshold for tax. So I probably should have mentioned this in the beginning, but if you don't earn more than 83,100 over the year, then it means that you won't be taxed, like you don't have to pay income tax at all. And essentially the lowest tax bracket, you pay 18% for that. And some quick maths, 18% times 83,100 is actually equals to that 14,958. No, I did not do that in my head, and I know you know that because, yeah. So that's essentially your tax rebate if you are under the age of 65, and that's called your primary rebate. You have a secondary and tertiary rebate depending on if you're over 65 but less than 75, and then if you're older than 75. Cool. And then the last sort of rebate that you have is your medical rebate. So it's called. So just to recap, you have your gross income, you subtract your exempt income, then you subtract your deductions, and that gives you your taxable income. you use the tax table to calculate what your tax amount is. And by the way, you can also check out TaxTim. They have a tax calculator that you can use as well. And once you have your tax amount, then you subtract your rebates. So there's the primary rebate if you're less than 65, and then you have your medical tax credits, and yeah, subtract those rebates, and then it means that you have your tax payable. So now it gets to the fun part of figuring out whether you will be getting a refund from SARS or not. So in order to know whether you'll be getting a refund, you take your tax payable and you take your pay as you earn. So your pay as you earn is that PAYE amount that your company has been contributing on your behalf to SARS. So when you get your pay slip, you're super excited, like I'm getting all this money, and then it was like, because there's all these amounts that have been taken away already. The pay as you earn is the amount that your company was taking and paying to SARS on your behalf. And essentially, in order for you to calculate whether you get a refund from SARS or whether you might have to pay SARS a bit more money, is you take your tax payable amount and you subtract your pay as you earn amount. So if your pay as you earn amount was greater than your tax payable, it means that SARS owes you money because you gave them more money than they required from you in the first place. But if your pay as you earn is less than your tax payable amount, it means that unfortunately you have to top it up so that you can pay SARS the amount that is due to them. And yeah, I hope that you enjoyed this video. If you have any questions, please put them in the comment section and I will try to answer them in the comment section, or I might make a video just to explain it a bit better as well. But yeah, like I said, it's going to be a tax series, so I have a couple more videos that I'm going to be producing for you. You know what it is, what it is. So if your question is going to be answered in a video that I'm already planning to do, then just look out for that. Otherwise, I'll answer it in the comment section, or I might just make a separate Q&A video about tax. But yeah, I hope that this video helped, and just a disclaimer, I'm not a tax practitioner. I just did a lot of research. It's on the SARS website. I was reading all of these things, and yeah, I hope that you enjoyed this. Please share the video. Someone might need this information, and please subscribe, please like, comment, tell me all your questions, or if you have additional information for everyone, put it in the comment section. And yeah, thank you for tuning in. Mwah, mwah.